Hello there. In this video, we're going to think some about Form 1040 and Form 1040A. We call this topic the expanded tax formula. Form 1040 is the long form tax return. 1040 is a short form between 1040EZ and Form 1040. There are four filing statuses for individuals according to the Internal Revenue Service. There's single filing status, married filing jointly, married filing separately, and head of household. Single and married filing jointly are something we talked about a little earlier in the earlier videos. I think they make common sense. Married filing separately is a case where if you are married, you cannot choose single. So basically, this is a little simplistic, but it works out that if one spouse makes a great deal more money than another, married filing jointly works better. That status is the old status, and it was used when one spouse was the primary breadwinner and the other spouse was more of a stay-at-home or lighter working spouse. Married filing separately is a more modern filing status that is aimed at people who pretty much make equal income. Head of household is a case where somebody may not be married any longer and may be taking care of children. We're going to think about dependents, and when we're thinking about dependents, we need to think about the children of divorced or separated parents and how we treat them. So with regard to parents, normally a qualified child is the child of the custodial parent. However, if there are four tests met, then the qualifying child can be the non-custodial parent's deduction. So first, if the qualifying child of the non-custodial spouse is in a case where both spouses have the child more than 50% of the year, then this is one test. If either or both parents pay more than 50% of the support, then this test, the second test is satisfied. The parents have to be legally separated or divorced, not just separated in the same household or something like that, but it has to be a legal separation. And there has to be a written documentation many times that says, a written document that says the custodial parent gives the right to claim the deduction to the non-custodial parent. What that written deduction does is it keeps at bay the possibility that both parents would try to claim the deduction. Only one parent can. What's qualifying relative? I was in one place one time where I was helping people do taxes, and many of the people weren't sophisticated, but somewhere got the idea that you could claim qualifying relative for people that weren't your relatives. And indeed, that's not true. You can see the list here. A child is not a qualifying relative. The child may be a qualifying child, but it's not a qualifying relative. Or I should say he or she is not a qualifying relative. There's a relationship test. Is the qualifying relative a child, a stepchild, foster child, sibling, step-sibling, father, mother, aunt, uncle? But again, a child would be a relation, but it would be a child, not a relative. The gross income for a qualifying relative has to be less than $3,950, and the person claiming a qualified relative as a dependent has to provide more than 50% of the support for that relative. Let's think about standard deduction. We're going to talk later about something called itemized deduction, but for now, standard deduction is basically $6,200 for a single person, $12,400, double the $6,200 for married filing jointly, $6,200 for married filing separately, $9,100 for head of household. These are all amounts that you can subtract from adjusted gross income to get to taxable income. Then, if a person's blind or over 65 and they're single, you add $1,550. If a person's blind or over 65, you add $1,200 to married filing jointly, $1,200 to married filing separately, and $1,550 if person's blind or over 65. Now, one thing about the married filing jointly, if both spouses are blind or both spouses are over 65, you'd actually add $2,400, not $1,200. For a qualifying widower, the standard deduction is $12,500, and if the person is blind or over 65, you would add $1,200 to their standard deduction. Interest is charged anytime tax is not paid. So there can be a small failure to file penalty. A lot of times there's very large failure to pay penalties because basically what happens is there's a penalty and then interest is charged on the unpaid tax and on the unpaid penalty. The current rates have been approximately 3 to 5%, but the IRS uses tables to set them, and they base them somewhat on the cost of living adjustments. So that's the expanded tax formula, Form 1040. Let me know if you have any questions.